What's next for stocks, Peter?
Thank you, Vanessa. So, stocks are looking good and favorable for the year. We are still in the expansion territory off of the bear market lows of October 22. Last year, we saw strength through the beginning of the year, only to come down through the second third of the year, and then again a bottoming in October of 2023, and saw a really healthy expansion into November and December. That continues today, which is good. So we have improvement, and that continuation in stock trends is really supported by that disinflationary trend where we have inflation rates coming down, which is a positive. The Fed is done raising interest rates, which again is another positive, and may in fact pivot and start cutting rates this year. And finally, corporate earnings and corporate health are strong, which gives a good support to rising stock prices. I think through the year, we may see some volatility, given that right now there's a lot of euphoria in the system. So sentiment gauges are very, very high or very bullish. And usually that's a contrarian indicator. So, more people are in stocks and stuff, so it can predicate some weakness, but that weakness will most likely be short-lived. The other concern this year is all the geopolitical risks that's out there that we all know about. And then also we're in an election year, and elections are always interesting. This year may be a little bit more, so that can cause some weakness kind of mid-year. But I think then we get past it, we end up at the end of the year with another strong, hopefully finishing for 2024.
Those are really good points. And one of the key questions out there about stocks at this level is, are they overvalued? And we saw this valuation expansion really accelerate since October of last year. And maybe, some parts of the market are overvalued based on where earnings are today. But behind the scenes, productivity has been improving at a fairly rapid pace. And a number of companies are pointing to some higher profits, which you'd hope it would relate to higher prices in stocks. But that with the employee count reductions, it's a good setup for many, many, many companies. But are valuations elevated? Yeah, one has to say they are rather elevated today.
I agree, but with valuations being high, it's not necessarily a timing tool. And I think earnings will grow into the valuations. And then earnings can furtherly be boosted by the improvements in productivity, the advent of AI, which can improve that. And finally, some of these labor reductions or layoffs or kind of right-sizing businesses can make businesses much more profitable by improving margins. So that should be a good tailwind for the year.
Steve, can you talk a little bit about Wall Street earnings expectations and how we may see some price improvement based on those expectations, potentially having upward revisions?
Yeah, and it's something that's been vacant in the last 6 months because I follow the earnings per share estimates from the analysts fairly closely, and throughout the last part of 2023, there were no increases in the earnings expectations for 2024. It was all valuation expansion in the market, and the analysts have been pretty stubborn in putting forth EPS expectation increases. Even for 2025, they're just up slightly. But it looks like back-to-back double-digit gains in earnings per share, 2024 and 2025. All else being equal, if you increase earnings, let's just take it 10% a year, and price-earnings ratios stay the same, what's that do to stock prices with the same PE? So that's where, Peter, your comments about companies growing into their valuations, that's probably what we're going to see, and then we'll get a little bit of optimism. You would think back into the market for stocks as the economy goes through its soft landing or no landing, and it looks like a pretty good environment for stocks going forward.
Right.
And Mark,
Well, let's extend our conversation kind of beyond the large cap US stocks that really have dominated the headlines in the past year. We've had a market with extreme concentration. We've heard a lot about the Magnificent Seven, seven large tech companies that have dominated in terms of stock price movement. And they've been driving the S&P 500 return. But, there's another 493 stocks. 490 of them really haven't had as much pricing movement as the others. So I think we take a moment to focus on where the PE, the price to earnings, or the valuation is. Those stocks have literally almost double the PEs of international emerging market, and certainly some opportunities in the mid and small cap US market. So if we're out there trying to buy, a dollar's worth of earnings, we're able to extend our view and have a greater opportunity set from which to invest. And if the economy does well, markets broadening out, we would expect that more companies would participate in that positive and significant opportunity.
thank you. Yes, we're trying to really focus on companies that are really going to benefit by changes in the overall economy, and that's really productivity enhancing businesses such as technology, where they're implementing now artificial intelligence to improve workflows and efficiency, and those will be great areas. The other areas in the market too represents valuation disparities. So like what you're talking about within the small caps and mid caps, and those are opportunities too, which should be supported by a declining interest rate environment. So I think there's a lot of opportunities in today's market.
I've heard you talk a lot about AI, specifically in the fact that at this point in time, the companies that are at the digital forefront, the companies that are actually developing the AI, are the ones that have seen the benefits. And we may actually start to see the productivity enhancements from the users of AI. So I think that's another really interesting trend that could develop this year and into the future.
Exactly. It's seeing the integration and being able to apply that efficiency to the businesses. And then finally, increasing kind of user engagement and things like that. So it's still in its infancy, early innings, and there's going to be a huge evolution, but we're excited to be participating in a lot of those businesses and kind of watching it as it enhances overall productivity for the economy.
I think it's an interesting theme. You talk about thematics issues, and that's going forward, that is going to be key to which companies, which management teams can hone their corporations to produce, the most profits with, from every dollar of revenue. And in this, in this valuation mismatch, Vanessa, you brought up, it's at its widest gap than we've seen in years. The difference between international large cap in the S&P 500, emerging markets in the S&P 500, and even small and mid cap companies in the S&P 500. Everywhere you go, this broadening of market participation should lead to more companies. You noted the other 493 companies. These companies should perform as the economy broadens, and they're able to use the tools to increase their productivity. And one would think that the valuation would find those companies, certainly. And it's always an interesting balance as, we manage client portfolios, because there's the fear of missing out countered with the fear of paying tax. If you own some of these the Magnificent Seven or the Fabulous Four or the top 10, taxable clients have very large capital gains in these issues. And the challenging thing going forward is, at what point does the broadening of participation in the markets come to a point where it makes sense to take some profits and realize some gains and redistribute the proceeds amongst some of the stocks that are great companies, but just haven't performed. And that's a very individual decision, based on the client advisor relationship and, where the client is with respect to all of their estate plans.
those are great points, and I think it comes back to, in my mind, that, you know, investing requires a lot of patience. We have to have perspective too on kind of the landscape as we've been discussing, what opportunities are out there, looking at the different inputs of valuation, interest rates, and whatnot. Inflation, of course, but then also the persistence, and as managers trying to be persistent with our methodology, working with clients to understand what their risk tolerances and investment objectives are, because they're unique to every individual. And then we tailor the portfolios to meet those needs. I think in aggregate, you know, this year is looking to be potentially a good year again with those longer term trends, where we have, you know, the disinflationary trend, the Fed potentially cutting, a resurgence in corporate profits. We have good consumer health right now. You know, yes, there's worries on the landscape, as there always are, as markets are always, you know, climbing a wall of worry, as they say. But we will get through, you know, we'll get through the election, the different volatility periods. The most important thing in my mind is really focusing on that long term. Again, having the patience to get there, the perspective and the perseverance.